China probably will eat those tariffs, but at 145, they basically can't do much business with the United States. And they were making from us $1 trillion a year.
President Trump's decision to levy sweeping tariffs on a wide array of foreign goods, beginning with steel and aluminum in early 2018 and expanding to hundreds of agricultural products later that year, triggered a cascade of consequences across America's farming heartland. These tariffs, designed as leverage in broader trade negotiations, most notably with China, sought to curb alleged unfair practices, but instead reverberated through the agricultural sector, imposing new costs on inputs, inviting retaliatory duties on U.S. exports, and compelling the federal government to intervene with unprecedented bailouts. As a result, farmers from the Midwest to California found themselves grappling with volatile markets, shrinking profit margins, and a reshaped landscape that favored larger operations over small family farms. Before we start, hit the like and subscribe buttons for more exclusive news. From the outset, the agriculture-related tariffs were part of a broader protectionist strategy. In April 2018, China imposed retaliatory tariffs of 15-25% on 94 lines of U.S. agricultural goods, focusing initially on pork, fruit, and tree nuts. By July, those duties had expanded to 697 lines, and by September 2019 to over 1,000, with certain products like soybeans subject to as much as 8,100% tariffs. The U.S. countered with its own levies on Chinese imports, setting off an escalating tit-for-tat that slashed market access for American commodities and undermined farmers' ability to sell into what had long been their most lucrative foreign market. Nowhere was the impact more acute than in the soybean sector. Once the backbone of U.S. farm exports, soybeans saw Chinese purchases plummet by 77% almost overnight after Beijing's tariffs took effect, wiping out more than $19 billion in export value by the end of 2019, nearly 3/4 of the total $27 billion lost across all agricultural goods during that period. This dramatic decline forced soybean prices downward domestically, leaving farmers with surpluses they could not easily reroute to other markets, and triggering financial distress in states like Iowa and Illinois, which together accounted for roughly $1.4 billion and $1.41 billion in annualized agricultural revenue losses in 2018 alone. Faced with these unprecedented losses, the Trump administration enacted the Market Facilitation Program, MFP, a series of direct payments through the U.S. Department of Agriculture intended to offset farmers' tariff-related damages. Between 2018 and 2020, the USDA distributed approximately $23 billion under MFP, with $14.4 billion dispersed in 2019 alone across 644,000 operations, averaging $22,312 per recipient. While this aid provided a critical lifeline, it also sparked controversy. Critics argued it perpetuated a dependence on government subsidies, disproportionately benefited larger farms, and masked the underlying market distortions caused by the very policies it was meant to mitigate. Small and independent farms felt the brunt of the trade war. Analysis by Food and Water Watch revealed that during Trump's first term, farm bankruptcies surged by 24% between 2018 and 2019, while the number of the smallest farms, those under 10 acres, declined by 14% from 2017 to 2022. In regions such as rural MAGA heartlands, where family-owned plots predominate, these pressures forced many operators to sell land or pivot away from staple crops like soy and corn, consolidating production in the hands of larger, better capitalized agribusinesses. The Midwest's losses were starkly uneven. Iowa alone lost $1.46 billion in agricultural revenues in 2018, followed closely by Illinois and Kansas, which suffered losses of $1.41 billion and $955 million respectively, together accounting for nearly 30% of all U.S. farm income declines that year. These figures underscored how tariffs on key exports rippled through rural economies, affecting local businesses reliant on farm spending, from equipment dealers to grain elevators, and fueling broader economic anxiety in communities already challenged by low commodity prices and rising input costs. Tariffs did not only strike at revenues, they also raised the cost of critical farming inputs. By imposing duties on steel, aluminum, and various manufactured goods, the administration inadvertently increased the price of tractors, irrigation equipment, even fertilizer applicators, squeezing already thin margins. A report by Sentient Media emphasized that these cost increases, combined with supply chain delays, made U.S. agriculture less competitive globally, while simultaneously driving up domestic food prices in what economists call a price wedge, where buyers pay more and sellers receive less than in a free trade scenario. Certain specialty crops experienced acute tariff pressures. California almond growers, who supply roughly 80% of the world's almonds, saw exports to China and other retaliatory markets shrink dramatically after Beijing slapped a 125% tariff on U.S. nuts in 2018. By early 2025, almond prices at the farm gate had fallen from about $2.50 per pound to $1.40, and analysts projected up to $868 million in lost export revenue if duties remained in place. Although increased domestic supply can sometimes lower retail prices, and indeed Californian supermarkets saw a modest drop in almond costs, growers with narrow profit margins reported significant financial stress, awaiting further federal assistance that had historically been scant for tree nut producers. Pork producers faced a similar ordeal. China's 25% retaliatory tariff on U.S. pork exports crushed sales in what had been America's second-largest market, prompting the USDA to purchase roughly $1.2 billion in surplus pork through its food purchase and distribution program. Dairy farmers also received aid. $500 million went to dairy in 2019. Yet many argued that these piecemeal relief measures provided little comfort amid steep declines in milk and cheese exports, which in some cases fell by more than 20% within months of the tariff's imposition. Beyond immediate financial losses, the tariffs accelerated long-term structural changes in U.S. agriculture. Larger farms with access to capital and diversified operations were better positioned to absorb volatility and apply for bailout funds, widening the gap between agribusiness giants and smallholders. The result has been further consolidation. In 2024, the top 1% of farms accounted for nearly 20% of total farm income, a figure that rose by 3% since 2017, while small-scale farms struggled to break even or exit the industry entirely. Disparities extended to minority farmers, especially black growers, who historically receive less USDA support. Trade-related losses compounded existing barriers to land ownership and credit access, pushing many minority-operated farms closer to foreclosure. Although the administration touted equity-focused programs, these saw budget cuts concurrent with expanded bailouts for larger producers, undermining efforts to support historically underserved communities. Consumers, meanwhile, experienced the ripple effects differently. While some retail prices edged upward, U.S. lettuce and tomato prices saw spikes of 5–8% in late 2019 due to imported tariff-induced input shortages. Other goods, like California almonds, became marginally cheaper as exports slowed and domestic stockpiles grew. Overall, studies suggested net welfare losses for American consumers, who paid an estimated $15 billion more annually in food and household goods costs due to tariff-induced inefficiencies. Internationally, the damage to U.S. credibility in trade negotiations has been significant. Long-standing partners in the European Union and Canada, already chafing under separate steel and aluminum levies, have signaled reluctance to engage in further concessions, even as the U.S. seeks to renegotiate bilateral deals. Agricultural stakeholders warn that the erosion of trust could impede future market access, especially for high-value products like beef and wine, and embolden other nations to erect their own non-tariff barriers. By spring 2025, the farm economy was starting to see the first hits from any new tariff announcements, with reports of delayed machinery purchases, constrained chemical imports, and cautious credit markets. Farmers interviewed in California's Central Valley describe an atmosphere of uncertainty. While optimism for negotiating breakthrough deals remains, many are bracing for continued market disruptions and debating further shifts toward direct-to-consumer models or diversification into non-tariff exposed crops such as hemp and organic produce. Some producers have sought refuge in alternative export destinations. South Korea, Mexico, and select Southeast Asian markets have absorbed increased volumes of U.S. soy and pork, albeit often at discounted prices to compensate for logistical challenges and competitive pressures. Meanwhile, domestic initiatives like farmer cooperatives and state-level promotion programs have tried to bolster local consumption, with mixed success in stabilizing incomes amidst global trade uncertainty. In retrospect, the design of tariff relief through bailouts has drawn scrutiny for its lack of market-oriented solutions. Economists argue that while direct payments provided temporary relief, they failed to foster new trade relationships or encourage productivity-enhancing investments. Calls are growing for more comprehensive agricultural policy reform, one that balances fair trade enforcement with proactive export promotion, research into resilient crop varieties, and targeted support for small and minority farmers. As policymakers weigh the future of U.S. trade strategy, the agricultural sector remains a cautionary tale of unintended consequences. Tariffs meant to protect domestic industries instead invited retaliatory blows, disrupted supply chains, and deepened structural inequities. The lessons from this period emphasize the need for a nuanced approach to trade policy, one that safeguards farmers' global competitiveness while minimizing collateral damage to the broader food system. Across the breadth of America's agricultural landscape, Trump-era tariffs initiated shifts that permeated far beyond immediate balance sheets, reshaping credit relationships, research priorities, land use patterns, and community dynamics in ways still unfolding. As farmers contended with market disruptions and federal relief packages, many found themselves reevaluating long-held assumptions about risk management and the very nature of their operations. One of the most underexamined consequences emerged within rural credit markets. Community banks and farm credit system lenders, traditionally the lifeblood of agricultural financing, grew increasingly cautious as uncertainty mounted around commodity prices and export volumes. Where once a diversified corn-soybean rotation might secure a 10-year operating loan, lending officers began tightening covenants, demanding larger equity cushions and more detailed contingency plans. Young and beginning farmers, already facing hurdles to land ownership, found credit access contracting, slowing generational transfers, and prompting some to postpone expansion or technology upgrades that could have enhanced productivity. Beyond tightening credit, the tariffs indirectly influenced research funding at land-grant universities. As revenue shortfalls pressured state budgets, a number of key agricultural research initiatives saw budget cuts or delayed launches. Programs focused on disease-resistant crop varieties, soil health assessments, and precision ag technologies faced funding vacuums just as producers increasingly needed tools to adapt to volatile markets. In response, university researchers scrambled to pursue alternative grants, while some extension services reduced field days and on-farm demonstrations, traditionally the primary conduit for new practices to reach farmers, leaving producers with fewer avenues to learn about innovations that might offset trade-related losses. At the level of land use, there was a subtle but significant pivot toward diversification. Faced with depressed prices for staple row crops, some operators explored specialty and niche markets previously considered too marginal for large-scale production. Hemp, legalized federally in 2018, drew interest as a potentially high-value rotation crop, though cultivation challenges and regulatory ambiguities slowed widespread adoption. Similarly, organic certification, community-supported agriculture, CSA models, and on-farm processing ventures gained traction as producers sought to capture more of the consumer dollar and hedge against global trade vagaries. These endeavors, while promising, demanded new skill sets in marketing, post-harvest handling, and regulatory compliance, stretching the capacities of traditional farm households. The mental health dimension of the trade disruptions has also garnered increasing scrutiny. Studies conducted by agricultural extension psychologists revealed elevated levels of stress, anxiety, and depression among farming families during the height of tariff clashes. The combination of financial strain, unpredictable weather, and long-standing profit squeezes took a toll on personal relationships and community cohesion. Local health clinics, particularly in underserved rural counties, reported surges in inquiries for counseling services, even as they struggled with staffing shortages. A handful of county cooperatives and nonprofit organizations responded by launching peer support networks and confidential hotlines tailored to farmers, but the stigma around mental health in rural America often blunted utilization rates. Further downstream, the toll on ancillary industries, everything from grain hauling and silage contractors to equipment repair shops, was considerable, with farmers deferring large purchases of combines, tractors, and irrigation infrastructure. Heavy equipment dealerships saw revenue declines that in turn affected their ability to offer credit or retain skilled technicians. Trucking firms that specialized in moving grain to export terminals found themselves racing to fill deadhead miles, occasionally securing loads of cheaper commodities destined for domestic feedlots, but at lower margins. In these ripple effects, the tightly interwoven fabric of rural commerce felt threads pulling loose. Even as core farm operations remained solvent under government assistance, water resources and environmental programs experienced indirect pressures as well. The Environmental Quality Incentives Program, EQIP, and Conservation Stewardship Program, CSP, both administered by the USDA to promote soil and water conservation, witnessed enrollment fluctuations as producers prioritized immediate cash flow needs over long-term conservation contracts. Some farmers deferred cover cropping and reduced no-till acreage expansions because short-term economics under tariff stress favored maximizing planted acres of income-bearing crops. In watersheds already suffering from nutrient runoff, these shifts risked exacerbating harmful algal blooms, while stewardship goals intended to improve pollinator habitats saw slowed progress. Environmental non-governmental organizations raised alarms, urging policymakers to safeguard conservation budgets against future trade-induced budget cuts. Legal and policy arenas became battlegrounds over the very legitimacy of unilateral tariff imposition. Farming groups joined broader coalitions to challenge the administration's Section 232 and 301 tariffs in federal courts, arguing that such measures exceeded executive authority and violated both statutory and constitutional constraints. Though several district courts issued mixed rulings, some affirming the president's broad discretion over national security-based trade actions, others insisting on tighter congressional oversight, the legal wrangling consumed agricultural advocacy groups' bandwidth. Time and resources spent on litigation diverted attention from developing constructive policy proposals or investing in grassroots outreach to consumers. Internationally, the long-term reputational effects on U.S. agricultural products began to surface. In markets beyond China, importers who had diversified their sourcing during the tariff turmoil hesitated to restore pre-tariff purchase levels, concerned that political volatility might once again restrict trade. Buyers in the European Union and Japan, having trialed Australian, Brazilian, or Ukrainian grains and oilseeds, found competitive alternatives at comparable quality and reliability. U.S. exporters, once assured of their quality and logistical prowess, now faced the arduous task of rebuilding market share, negotiating phytosanitary protocols anew, and shouldering the costs of promotional campaigns abroad. The USDA's Foreign Agricultural Service ramped up in-market support, funding booths at trade fairs and subsidizing buyer delegations, but the inertia of buyer diversification proved challenging to overcome. Beyond conventional export markets, the tariffs fueled innovation in domestic supply chains. Craft distillers and microbrewers, encountering higher barley and hop costs imported under steel and aluminum levies, began sourcing more domestic grains, spurring regional barley breeding programs and hop farms. This shift supported the nascent farm-to-barrel movement, linking local grain growers with beverage artisans. While it did not offset the broader losses from row crops, it exemplified an adaptive strategy, forging closer vertical integration between producers and value-added processors to insulate against global shocks. Consumer attitudes also underwent nuanced transformations. A 2021 consumer survey by a major agricultural think tank revealed that, amid rising grocery bills linked to tariff-inflated input costs, a growing segment of shoppers expressed interest in buying local and supporting American farmers. Farmers' market sales saw modest upticks, and small-scale processors of pickles, salsas, and heritage grains reported increased retail placements, suggesting that domestic branding resonated amid trade uncertainties. However, price-sensitive consumers in lower-income brackets faced real hardship as staple foods edged upward and food bank usage climbed in agricultural regions once considered relatively food secure. Within the halls of Congress, the agricultural community's complex experiences fueled fractious debate. While some representatives lauded the administration's resolve to stand up to unfair trading partners, others lambasted the collateral damage and pressed for swift re-engagement in multilateral frameworks such as the World Trade Organization's dispute settlement mechanism. A bipartisan caucus on farm exports emerged, proposing legislation to limit the president's unilateral tariff powers on agricultural inputs exceeding a defined economic impact threshold, and to establish automatic countermeasures funding tied to export volume declines rather than ad hoc relief programs. On the ground, cooperative structures morphed to meet new needs. Some regional grain cooperatives that had once focused solely on collective marketing pivoted to offer risk management education, securing group discounts on crop insurance, and facilitating peer-to-peer workshops on hedging strategies in the futures markets. Others invested in satellite-based yield mapping services and drone scouting to help members optimize inputs, reducing dependency on imported fertilizers and chemicals whose prices had spiked under broader tariff schemes. These cooperative-led technology adoptions, while modest in scale, hinted at a collective resilience born of necessity rather than preference. In parallel, private sector agritech firms seized opportunities to demonstrate efficiency gains that could soften the blow of trade-induced volatility. Sensor-based irrigation controls, variable rate nutrient applicators, and AI-driven pest detection platforms saw accelerated adoption among larger farms seeking to squeeze every margin point. While some lamented the growing technology divide between well-capitalized operations and smaller farms, the broader acceleration of digital agriculture signaled a permanent shift in production paradigms. Policymakers and extension agents, recognizing the digital agriculture acceleration spurred partially by tariff stress, began advocating for expanded broadband infrastructure in rural counties and increased funding for digital literacy programs among farm families. Another noteworthy domain of impact was on land valuations. As export prospects dimmed and interest rates remained historically low, farmland values in many highly export-oriented regions either plateaued or, in extreme cases, declined slightly, marking a departure from the steady appreciation seen throughout the prior decade. Lower land prices offered an opening for new entrants and young farmers, but also raised concerns about undervaluation of rural assets, which could constrain wealth building and retirement planning for multi-generational farmers. Agricultural economists examined the interplay between land price corrections and credit availability, cautioning that too precipitous a drop could trigger distress sales, further consolidating land in the hands of large agribusinesses. Meanwhile, the intersection of tariffs and climate change adaptation loomed large. Where government relief had once focused narrowly on restoring lost export revenues, climate-related assistance programs, such as those incentivizing drought-tolerant crop varieties or flood-resilient soil management, gained higher visibility in policy circles. Some state departments of agriculture, aiming to future-proof their producers, reallocated resources toward climate-smart grants, arguing that resilience to weather extremes would also mitigate vulnerability to trade shocks. For instance, in Nebraska and Kansas, pilot programs funded cover crop incentives and enhanced weather forecasting services, positioning farmers to manage both market and environmental risks more holistically. In the realm of supply chain governance, larger agribusiness buyers, packers and processors of meat, grain merchandisers, and food conglomerates responded to tariff-driven instability by renegotiating procurement contracts to include force majeure clauses explicitly covering trade policy disruptions. Such legal language, once reserved for natural disasters or political unrest abroad, became commonplace in domestic contracts, transferring some burden of uncertainty back onto suppliers. This shift prompted legal scholars to debate the evolving nature of buyer-seller relationships in agriculture, with implications for contract law and antitrust oversight. Reflecting on the full tapestry of effects, it becomes clear that tariffs function not merely as a lever of trade policy, but as a catalyst for structural realignments across the agricultural ecosystem. While relief payments provided essential lifelines, they also postponed necessary adjustments to global market realities. Looking ahead, the sector may benefit from governance frameworks that tie relief more explicitly to innovation, diversification, and sustainable practices, ensuring that when trade disruptions occur, they spark constructive transformation rather than perpetuate reliance on government backstops. As 2025 unfolds, agricultural stakeholders are charting courses that emphasize agility and diversification. Strategic partnerships between universities, cooperatives, and agritech startups aim to develop resilient crop systems, foster local processing hubs, and expand domestic value chains. Federal policymakers are contemplating proposals to integrate trade risk insurance into crop insurance programs, offering premium discounts to producers who demonstrate proactive market diversification strategies. Such policy innovations, if implemented, could reorient the safety net from reactive bailouts toward proactive risk management. Meanwhile, on family farms from the Red River Valley to the Imperial Valley, producers are sharing stories of adaptation, how they retooled warehouses to sort locally grown pulses for artisanal markets, or invested in solar arrays to reduce dependence on grid electricity whose cost rose after tariffs on steel components used in solar panels. These grassroots experiments, though diverse in approach, share a common ethos, turning disruption into opportunity by weaving new value streams beneath the familiar rhythms of planting and harvest. In communities where farm families once viewed tariffs solely as an external threat, conversation now centers on building resilience through local food hubs, renewable energy projects, and collaborative marketing platforms. School districts in rural counties, recognizing their role as anchor institutions, have begun sourcing more produce from nearby farmers, bolstering regional food networks initially energized by tariff-induced localism. Healthcare systems, too, are exploring farm-to-clinic programs that supply community health centers with fresh produce, reinforcing public health through dietary innovation while supporting local growers. At the national level, the ongoing dialogue over trade policy has become more inclusive of agricultural voices, as policymakers acknowledge that farmers' perspectives are integral to both economic and geopolitical strategies. Rather than treating agriculture as a bargaining chip, emerging trade proposals emphasize sector-specific consultations, binding dispute resolution timelines, and integrated development programs intended to ensure that future agreements safeguard market access without triggering abrupt, retaliatory escalations. The journey from tariff imposition to sector-wide transformation reveals a paradox. Policies designed to project strength and leverage often exposed vulnerabilities that had lain dormant beneath decades of relative trade stability. Yet within the disruptions, seeds of renewal took root as farmers, rural lenders, researchers, and community leaders experimented with new models of production, finance, and governance. The ultimate measure of this period may be not the immediate losses tallied in subsidy payments or export shortfalls, but the innovations that emerged in response, innovations that could redefine American agriculture for a more interconnected, unpredictable world. Beyond the immediate market disruptions and policy maneuvers, Trump-era tariffs also reshaped the very composition and stability of the farm labor force. At a time when seasonal H-2A visa programs were already under strain, new uncertainties in crop prices led some growers to reduce plantings of labor-intensive fruits and vegetables, exacerbating labor shortages. Farm labor contractors found their margins squeezed as growers tightened budgets, even as rising local wage pressures, spurred by competition from non-farm sectors, pushed labor costs higher. In response, some operations piloted mechanized harvesting trials on specialty crops previously untouched by automation, investing in robotics and AI-guided picking systems. While these technologies remain costly and experimental, they signal a longer-term shift toward reducing reliance on volatile human labor markets, with implications for rural employment and community demographics. Meanwhile, the tariff period accelerated growth in environmental services markets tied to agriculture, ushering in new revenue streams for producers willing to adopt regenerative practices. Private carbon offset programs expanded their footprints across Midwest and southeastern row crop regions, offering payments to farmers who sequestered carbon through reduced tillage, cover crop rotations, or agroforestry buffers. Water quality trading schemes, originally conceived to curb urban wastewater pollutants, began incorporating credits generated by farmers who installed riparian buffers or implemented nutrient management plans. These ecosystem service markets, underwritten by corporate sustainability commitments, provided alternative income that softened the blow of export losses and reframed farm decision-making around multiple ecosystem outputs rather than yield alone. At the intersection of finance and technology, blockchain traceability projects gained new momentum. In search of added value to offset tariff-induced margin erosion, several Midwest cooperatives partnered with fintech startups to pilot end-to-end transparency platforms. Every bushel of corn or soybean issued a cryptographic token recording its origin, storage, and quality metrics. This provenance data proved attractive to institutional buyers, particularly in Europe and Japan, who were keen to assure consumers of non-GMO status, sustainability practices, or adherence to labor standards. By packaging these traceable traits as premium attributes, farmers accessed niche markets willing to pay $1 or $2 extra per bushel, laying groundwork for broader digital integration in commodity chains. Lastly, the broader philanthropic and international development community took note of the U.S. farm sector's travails. Foundations that traditionally funded global food security initiatives redirected some grant portfolios toward rural resilience in America, underwriting community food hubs, mobile processing units, and locally owned aggregation facilities. This influx of earmarked capital complemented USDA grants for value-added producer organizations, enabling small and mid-sized farms to process, package, and market products domestically. In parallel, U.S. agricultural attachés overseas began hosting Lessons from the Trade War seminars, sharing insights with partner nations in Central America and West Africa on how policy shocks ripple through farming systems, and how diversified value chains and community-centric models can build buffers against future disruptions. These cross-border dialogues, though modest in scale, reflect an emergent recognition that the vulnerabilities exposed by tariffs and the innovations born of necessity hold lessons for global food systems striving for both competitiveness and resilience. If you like this video, please give it a like and subscribe to our channel. Also, could you leave your comments below and tell us, what are your thoughts on Trump's tariffs? How have they impacted farming and agriculture? We want to hear from you. Thank you for watching, and see you next time.